It begins in silence, not the silence of emptiness, but the quiet hum of something hidden, something invisible, yet present in every store aisle, every online checkout page, every restaurant bill, every tap of a plastic card against a machine. A force that moves money without ever touching it. Today, the world lives in the era of invisible payments. The glide of a credit card, the tap of a phone, the frictionless transfer of value. But behind that simple gesture lies one of the most powerful financial networks ever created. A system processing over $12 trillion in transactions each year, connecting more than 200 countries, hundreds of millions of merchants, and billions of consumers. Its name is Visa. And yet, Visa does not lend money. It is not a bank. It does not decide who qualifies for credit. It simply moves money. Yet it earns more than nearly all the banks that do. This is the story of how a single idea, the idea of shared trust, transformed from a stack of carbon paper and manual registers into a global digital empire. The story begins long before technology, long before computers, before plastic cards. It begins with something far more human: fear. Fear of lending without certainty, fear of trusting strangers, fear of extending value when value might never return. For most of history, money was something you held: metal, paper, something physical. Credit existed, but only among people who knew one another. A handshake, a promise, a relationship. Then came the 20th century, where consumption grew faster than cash could move. Air travel, nationwide retailers, sprawling suburbs, distance expanded, but trust did not. By the late 1950s, American banks faced a new challenge. Consumers wanted convenience, to spend money they did not yet have. But banks had no unified way to verify identity, track payments, or collect debts from across the expanding map of American life. Each bank had its own rules, its own credit system, its own list of trusted customers. But if a customer left town, crossed a border, or shopped somewhere new, the system broke. Fraud was rampant. Losses were catastrophic. Credit was a luxury, fragile and unreliable. And then, from a quiet office in California, came a radical idea that would reshape global commerce. A network of shared trust. Not one bank alone, not one city or one region, but a cooperative system where every bank agreed to accept every card, regardless of origin. An idea so simple that it seemed impossible. The man who championed it was D. Hock, a little-known banker at the Bank of America. Frustrated with bureaucracy and inefficiency, Hock believed that money was not the challenge. Information was. In 1958, Bank of America launched the first mass-market credit card, mailed to over 60,000 people in Fresno, California. No applications, no warnings, just cards, sent to unsuspecting households. It was reckless. It was audacious. It was chaos. Nearly 20% of the cards ended up stolen, misused, or turned into uncollectible debt. Merchants were overwhelmed. Banks panicked. But something else happened. People used the cards. They wanted the convenience. They wanted the freedom to buy now and pay later. The experiment had failed financially, but succeeded culturally. The seed of Visa had been planted. But to survive, the system needed rules. It needed order. It needed structure. This is where D. Hock's genius emerged. He proposed something radical. A network not controlled by a single bank, not governed by top-down authority, but guided by cooperation. A decentralized organization where each bank was both competitor and partner. No single entity would rule. No one institution would dominate. In 1970, the Bank Americard system was spun out from Bank of America into a new independent organization, National Bank Americard Incorporated. Soon, it needed a new name, a name that represented universal acceptance, a name that could cross borders, languages, and cultures. The word chosen was short, simple, and globally recognizable: Visa. It conveyed movement, access, permission, a passport to financial freedom. But the name was only the surface. The real power lay beneath. Because Visa was not a card, Visa was not a product. Visa was a network of banks, merchants, and consumers, all operating under the same shared standards. A network built not on faith in individuals, but on trust in the system itself. By the 1980s, Visa had expanded across Europe, Asia, Africa, and Latin America. The blue and gold logo became a silent passport to commerce, accepted in hotels, airports, and storefronts around the world. Still, everything remained physical. Carbon slips, paper receipts, manual signatures, human error everywhere. Then came the computer revolution, and Visa was ready. While other financial institutions clung to legacy systems and outdated processes, Visa embraced the digital future with relentless ambition. In the late 1970s and early 1980s, Visa began constructing one of the most advanced data processing networks in the world, a global authorization and settlement system capable of transmitting payment data almost instantaneously. This network, known today as VisaNet, is one of the most resilient and powerful transaction systems ever engineered. Every time a card is swiped, every time a phone is tapped, every time money moves through Visa, it travels across this invisible digital highway. Consider what must happen in the fraction of a second when a customer buys something. The merchant sends a request. Visa transmits it to the bank that issued the card. The bank checks the balance or credit line. It verifies identity. It approves or denies the purchase. The response returns to the terminal, all in less than half a second. Faster than a blink, faster than a thought. This is Visa's real product, the ability to verify trust instantly. Today, Visa handles more than 65,000 transactions every second across a network with redundancy so deep that failure is almost impossible. It is no exaggeration to say that if Visa's network stopped, much of the global economy would simply freeze. Stores would close, flights would be grounded, online commerce would collapse. Visa is not just a company, it is infrastructure, as essential as electricity, as ubiquitous as the internet, as deeply embedded as the act of buying itself. But power on this scale does not come without consequence. With financial accessibility came financial dependency. With convenience came vulnerability. With global trust came global exposure, because Visa's empire is built not on currency, but on behavior. Every swipe, every tap, every purchase, every choice. Visa sees it all. It doesn't sell your data. It doesn't need to. The value lies in the patterns. Visa can map the rise of inflation before governments announce it. It can see economic downturns before financial markets react. It can identify emerging industries before the world notices. Visa knows when a recession is coming. Visa knows when consumer confidence changes. Visa can trace the shifting heartbeat of the global economy in real time. This knowledge is power, but also responsibility. The tension between these two forces defines the next era of Visa's story. Because the world of payments is changing once again, cash is fading, banks are losing authority, and a new frontier is emerging, one that threatens to rewrite the rules that made Visa dominant. Digital wallets, mobile payments, cryptocurrencies, decentralized finance. The challenge is no longer how to move money across distance. The challenge is how to move money without intermediaries. And Visa, a company built on being the ultimate intermediary, must now decide, adapt, or defend the old world. This is where our story turns. From history into strategy. From architecture into power. From convenience into the economics of control. The world is entering a new phase of financial evolution, and Visa intends not only to survive it, but to shape it, to be continued in Part 2. Part 2 will reveal how Visa makes billions without lending money, how interchange fees really work, The strategic war between Visa, Mastercard, PayPal, Stripe, Apple, and crypto, the hidden power struggles shaping the future of global payments. Part 2. The world rarely notices the systems that hold it together. We don't think about electricity until the lights go out. We don't think about plumbing until the water stops flowing. And we don't think about payments until they fail. Visa's true power comes from this invisibility. It moves in the background, silent, frictionless, almost unnoticed. But to understand how Visa became one of the most profitable companies in the world, without lending money, without collecting interest, without holding deposits, we have to enter the hidden machinery of the financial system. To the ordinary shopper, a transaction seems simple. A card is tapped, a receipt prints, a purchase is done. But beneath that moment lies a chain of institutions, agreements, fees, and information transfers, a choreography so complex that it took decades to perfect. At its core, every Visa transaction involves three key players: the cardholder, the person making the purchase, the merchant, the business selling the goods, and the issuing bank, the bank that gave the cardholder their Visa card. However, there is also a fourth player, often overlooked: the acquirer, the bank or processor that provides payment services to the merchant. Visa stands in the middle, connecting these sides, like a translator, referee, and infrastructure provider all at once. The moment a card is used, data flows from the merchant's terminal to the acquirer, then through Visa's global network to the issuing bank. The bank checks the account or credit line, evaluates the risk, and sends an approval or refusal. Visa relays the answer back, completing the loop. This entire process, from swipe to approval, takes about 400 milliseconds, less time than a heartbeat. But this speed hides the economics beneath it, because every card transaction involves fees, and the most important of these is called the interchange fee. This fee is paid by the merchant's bank to the cardholder's bank. In simple terms, when someone buys something with a Visa card, the merchant pays the bank that issued the card, as compensation for offering credit and assuming risk. Visa sets guidelines for interchange fees, but banks ultimately determine the exact rates. The merchant, in turn, pays the acquirer, who passes the fee along. For merchants, these fees are simply the cost of doing business. Refusing cards is not an option. Consumers expect convenience. Convenience drives sales, and cash only means lost revenue. This creates dependency, a dependency Visa understands deeply. The genius of Visa's business model is that the company does not touch the money it moves. It does not absorb credit risk. It does not chase collections. It does not finance purchases. Instead, Visa earns revenue by charging small fees on the movement of payment information, not on the money itself. Transaction fees, processing fees, international currency conversion fees, each tiny on its own, but multiplied across trillions of transactions, they become enormous. In 2023 alone, Visa generated more than $32 billion in revenue, with profit margins often exceeding 50%. Margin levels that most industries can only dream of. This is why Visa's business is sometimes called the toll road model. Visa built the highway. Banks provide the vehicles. Consumers and merchants use the road every day, and Visa simply charges a toll. The beauty of the model is that once the infrastructure is in place, scaling is almost effortless. Adding more users increases revenue, but barely increases cost. The network strengthens with each new participant. Economists call this network effect dominance. The more people use Visa, the more merchants must accept it. The more merchants accept it, the more banks must issue it. The more banks issue it, the more people use it. A self-reinforcing cycle. Once established, it becomes nearly unbreakable. But dominance invites competition. And Visa's greatest challenger has been at its side for decades: Mastercard. The relationship between Visa and Mastercard is not like Coca-Cola and Pepsi or Apple and Microsoft. It is closer to two parallel governments, each ruling overlapping territory in the same world. Both companies began in the same era. Both grew through the same concept of shared trust among banks. Both evolved into global payment networks. Yet Visa has always remained larger. More banks issue Visa cards. More merchants accept Visa globally. More transactions flow through VisaNet. The reason is not just strategy, it is timing. Visa had a head start. The Bank Americard experiment, however messy, gave Visa a network before Mastercard even existed. By the time Mastercard was formed as a consortium of competing banks, Visa was already expanding. Mastercard has always chased Visa, and yet, the two companies are not enemies. They share something far more important: a common interest in protecting the system, because the system is under attack. The threats come not from governments, nor from banks, nor from merchants. The threats come from technology. For decades, Visa and Mastercard built their power by controlling the rails, the infrastructure of payment movement. Every transaction had to travel through the network. But in the 2000s, new companies emerged offering something different: speed, simplicity, software. Companies like PayPal, born from the early internet, allowed consumers to pay online without entering credit card information repeatedly. Later came Stripe, offering easy payment tools for online businesses. Then Adyen, enabling global payment acceptance with less friction. And Square, turning smartphones into point-of-sale devices. These companies didn't replace Visa. They sat on top of it. They still relied on Visa's rails to move money, but they controlled the user experience. And in business, the one who controls the user experience often controls loyalty. Visa saw the risk early, and instead of fighting these new companies, Visa made a strategic pivot: partnership instead of resistance. Visa invested in startups. It signed integration deals. It provided APIs and developer access. It adapted its network to support digital wallets and mobile payments. Because Visa understood something essential: as long as money moves, the rail underneath matters. Whether the card is plastic or digital doesn't change the network. A Visa token stored in a smartphone wallet still travels across VisaNet when used. But then came the challenge that could not be ignored: cryptocurrency. Unlike PayPal or Stripe, crypto does not use Visa's rails. Cryptocurrencies move value without intermediaries. No issuing bank, no acquiring bank, no interchange fees, a system without a toll road. To some, this was a threat greater than any Visa had ever faced. A future where Visa becomes unnecessary, where consumers and merchants transact directly, peer-to-peer, globally, instantly. But there is a flaw in that vision. Most cryptocurrencies are not stable in value. They fluctuate wildly, and most consumers do not want volatility in their daily spending. Moreover, while blockchain can record transactions, it does not solve identity, fraud prevention, or dispute resolution. Core functions Visa has perfected. Visa understands this, which is why, instead of rejecting the future, Visa has begun building a bridge to it. Visa is researching digital currency interoperability. It is experimenting with enabling stablecoin and CBDC transactions through VisaNet. It is working with central banks on digital currency infrastructure. It is positioning itself as the translator between traditional finance and emerging decentralized networks. In Visa's view, the future will not be fully centralized, nor will it be fully decentralized. It will be hybrid. A world where digital currencies exist, but still rely on trusted infrastructure to scale globally. And Visa intends to be that infrastructure. But power does not come without scrutiny. Governments around the world have looked closely at Visa's dominance: antitrust investigations, fee regulation, market oversight. In the United States, Visa has defended its interchange fees against political pressure. In Europe, regulators capped interchange to protect merchants. In Australia, competition authorities demanded transparency. Yet despite regulation, Visa remains strong. Because the system is deeply entrenched. Consumers trust Visa because it works. Merchants accept Visa because they must. Banks rely on Visa because withdrawing would be chaos. Visa is not just a company, it is a standard. Replacing a standard is not simply a matter of offering a better product. It requires rewriting the world's financial DNA. And that is not easily done. But Visa is not invincible. There is a weakness. Subtle, but profound. Visa depends on the assumption that commerce continues to flow through centralized networks. If a new financial architecture emerges where value moves and is verified without intermediaries, the toll road could become unnecessary. Visa knows this. Its executives speak of the future of money movement, not the future of cards. Because cards are just an interface. The true business is trust at scale. Whoever controls trust controls transaction flow. Whoever controls transaction flow controls commerce. Whoever controls commerce shapes economies. This is the quiet power Visa holds, a power invisible to most, but understood deeply by those who study systems. And now, the story moves to the final chapter, where we will examine the psychology of spending, the social cost of credit, the ethics of convenience, and the future of an empire built on frictionless trust. Because when payment becomes invisible, so does restraint. And that changes everything. Part 3. The world today moves faster than the people who inhabit it. Vehicles move faster, communication moves faster, and money, once slow, physical, and deliberate, now moves with the speed of thought. Yet with speed comes something subtle, something psychological, something that changes not just how we spend, but how we feel about spending. Because when money becomes invisible, it stops feeling real. Before credit cards, buying something required presence. Cash changed hands, the weight of the wallet changed. We felt the cost. But when a plastic card replaced the physical exchange, and later, when phones replaced even the card, the sensation of spending faded. This is not accidental, it is structural. Behavioral economists have shown that when people pay with cash, they experience a small but measurable discomfort, a friction, a reminder of value leaving their possession. But when people pay with cards, the friction disappears. There is no physical loss, only permission, only approval, and frictionless spending means increased spending. This is where Visa's influence moves beyond infrastructure, into psychology. Visa did not just connect banks to merchants. It connected human desire to instant fulfillment. The network became not just a payment system, but a system of behavioral reinforcement, designed not to force consumers to spend, but to make spending feel natural, almost effortless. The architecture of modern consumption depends on this. Retail, travel, hospitality, e-commerce. Entire industries are built on the assumption that people will buy first and think later. Not because they are irresponsible, but because the system makes spending easy. Visa sits at the center of this consumer economy, not pushing, not persuading, simply making it possible. Yet possibility comes with consequence, because convenience is never free. Across the world, household debt has risen dramatically over the past half-century. Credit cards, loans, installment plans, tools meant to offer flexibility, now shape financial lives. Some use them wisely. Some fall into cycles they struggle to escape. Visa does not control interest. Visa does not collect repayments. But Visa enabled the architecture that makes consumer credit ubiquitous. And this is where the story becomes more than economics. It becomes societal. Because the ease of spending affects not just individuals, but culture. Consumption becomes identity. Lifestyle becomes performance. Status becomes something purchased. And Visa's network becomes the silent stage upon which modern consumer life unfolds. But culture evolves. Technology shifts. Systems face pressure. We are entering a new era, where the meaning of money itself is changing. Digital wallets now hold cards that aren't physical. Phones are becoming primary wallets. Wearables are payment instruments. The card is slowly disappearing. And behind the scenes, Visa has already adapted. Visa no longer cares whether the form factor is plastic, digital, biometric, or invisible. The card is an interface. The network is the product. Visa is now working on something deeper: tokenization. Instead of transmitting card numbers, Visa creates cryptographic tokens, unique digital identifiers that can be used once, then replaced. Tokens make fraud harder. Tokens enable secure digital transactions. Tokens allow Visa to move into a world where the card no longer exists. This is not a shift, it is an evolution. Because Visa understands that the real battle is not over cards. It is over the rails of the global economy. Who controls the movement of value? Who defines trust? Who verifies identity? Who ensures legitimacy? That is the foundation of financial power. And now, governments are awakening to this realization. Around the world, central banks are exploring CBDCs, central bank digital currencies, digital dollars, digital euros, digital yuan, currencies that could move without banks, currencies that could bypass existing networks, currencies that could challenge Visa directly. But central banks do not specialize in building commercial infrastructure. They do not design global merchant acceptance. They do not manage fraud at scale. They do not operate consumer identity networks. Visa does. And so, the likely future is not replacement, but integration. A hybrid system, where digital currencies exist, but Visa provides the rails, the identity layer, the trust layer, the very infrastructure of movement. Because Visa's greatest insight has always been this: money is not the product. Trust is. The ability to verify, to confirm, to guarantee. This is what Visa sells. And so, we return to the beginning. A world built on trust between neighbors, a handshake, a ledger, a promise. Except now, the handshake spans continents. The ledger spans billions of accounts. The promise is encoded in algorithms and networks. Visa did not invent trust, but it scaled it, globalized it, systematized it, and in doing so, it changed the nature of commerce itself. Today, when a card is tapped at a grocery store in Ohio, when a traveler checks into a hotel in Singapore, when a business orders parts from across the ocean, Visa is there, invisible, instant, reliable. An empire not of buildings or banks, but of connections, of agreements, of shared systems. A network so vast that removing it would freeze economies. A company so embedded that its influence is almost silent. A system so trusted that we rarely stop to consider it. Visa is more than a brand, more than a company, more than a network. Visa is the infrastructure of global commerce, the quiet architecture of modern life, the invisible empire that moves money and shapes the world. And like all empires, its future depends on one question: can it continue to adapt faster than the world changes? Because in the end, the story of Visa is the story of human trust, scaled to billions. A reminder that the most powerful forces in the world are often the ones we never see.